I have a saying that goes, people who don't pay attention. Yeah, if you're leasing the car, we can write off. We'll take all of the direct expenses, so we can write off the car payments, gas. I mean, all of the direct repairs associated with the car. But if you're financing a car, then yeah, we got to take, again, it's going back to the interest. We can't take the actual payments itself. Our general rule of thumb is once that business begins to net over $30,000, we should consider for that business to be taxed as an S corporation. My name is Eugene Marshall. I'm the founder and CEO of Magnolia Tax Services. Magnolia Tax Services is a tax advisory practice that specializes in tax planning. By default, with us being in the tax industry, we do tax preparation. We don't market ourselves as a tax prep firm. We market ourselves as a tax advisory firm by design, because there's only so much that we can do for a taxpayer or a client solely just filing their taxes.
Yeah.
Because when we're filing the tax return, we're just recording in the tax return what happened the previous year.
Right.
That's it. So we're limited to what we can do. But if we can plan with you periodically throughout the year, and we can introduce certain strategies like buying real estate or the Augusta rule, HSA, planning for retirement, it can get a lot more strategic than that. But it gives us the opportunity to be proactive rather than reactive. We also do tax resolution, which is a fancy word for we help represent clients if they've been summoned for an examination and or an audit. An examination is just a very small scale audit.
Okay.
And then we also assist them with getting some tax debt relief if they owe a ton of back taxes. And then we do accounting and bookkeeping. I've had my practice going on 3 years now. Before I started my practice, I was working in another tax firm. And outside of taxes, I'm also an avid real estate investor. I've been buying real estate since 2017.
Okay.
And I started out doing wholesale deals. We were signing contracts. I'm originally from Chicago. And in Chicago now, they actually made it illegal. Wholesaling is illegal. And you can still do it, but you can only do one wholesale deal a year within a 12-month interval.
Really?
And that's a signing, right? That's a signing a contract. So what a lot of people start doing is just double escrow closings, which is the loophole, because you're not assigning a contract. You're essentially buying the property, and then you're reselling the property the same day, typically within an hour or so. Some title companies can even do it sooner than that. And then I started doing fix and flips. That went okay. Quickly realized I didn't want to be in the fix and flipping business per se. Started out with a couple buddies of mine, and then I did a project on my own. Lost $50,000 on my first solo project, and I was like, okay. But really, what it comes down to is the general contractor. A lot of these general contractors rob Peter to pay Paul. And I got caught up in one of those scenarios.
Okay.
And then I graduated to buy and holds. And so I started buying 2-unit buildings, 3-unit buildings on the south side of Chicago. And then we eventually scaled to buying more larger residential multifamily properties, 8 units, 24 units. We're looking at a 52-unit right now.
Oh, wow.
Give or take, I'll still pick up a good cash flowing, duplex or triplex, depending on the location. And so, yeah, that's kind of my background is taxes and real estate.
Gotcha. So did you get into taxes and like all the loopholes and stuff after you started doing the real estate?
Yeah. So the real estate came first.
Okay.
The taxes came second.
Gotcha. And what did you learn, and how did you even like start your research on like learning about taxes? Is there like a spreadsheet that you can learn all about taxes, like when they released all the new tax codes that change?
Sure.
Where do you learn all that information?
Yeah. So fortunately for me, this is how I got into tax space. So a buddy of mine, he already had his tax firm, and he was the smartest person I knew at the time, richest person I knew at the time. Mm-hmm. And my mindset was, okay, if I can get closer to him, then I can learn how he's doing some of these deals. Yeah. I can learn how he got to where he's at. And he's only 3 years older than me. And an opportunity came up at his practice, and he was like, hey, look, you know real estate, you speak the language. I'm always advising and encouraging my clients to buy real estate for, tax benefits. I think you'd be a great fit. And prior to joining him, I was in a sales role. So I joined him. I learned a ton about taxes working in a tax practice. Secondly, I went and got licensed. I got my enrolled agent license. And what enrolled agents do is we study tax law. So enrolled agents, we can practice in all 50 states. Okay. We're not subject to state codes or state jurisdictions, if you will. We have a federal jurisdiction, so we can service all 50 states. And we do a ton of IRS audits. So how do you learn? I had to go and get licensed. But outside of getting licensed, there's a ton of required continued education to maintain that license as well. And I'm actively in a space. I was just in a conference this past week. I just got back last night. I was in Utah all week at a tax and legal conference. And it's important that, that continuing education is there, because I always got clients that got sophisticated things, and stuff changes every single year.
Are most of your clients businesses or personal?
Most of my clients are businesses. I would say maybe 95% of our client base are all small business owners. These are estate planning attorneys, medical professionals, MDs, optometrists, dental practices, realtors, lawn care companies, you name it.
Gotcha. And what's something that maybe a lot of people don't know about, an easy loophole that people could incorporate in their small business, or something that you really advise people to do that isn't very common or people just don't know about?
Yeah, so the important thing that I see right off the bat, one of the first things that we do is we want to see how the business is set up. Okay, that's the very first thing that we do before we start talking about loopholes and you can do this and you can do that. How is the business set up? Because what happens is a lot of small business owners, they immediately start to think about tax deductions, what I can write off, what I can't do. But we got to remember that the number one key fundamental thing in business is to create income, right? Not what the write-offs are, but it's how do we create income? Because if you can master that, and that's a skill, believe it or not, a lot of folks don't realize that creating income is a skill. And so if we can get the concept and the foundation of creating income down first, then we can start talking about tax deductions. So hypothetically, let's say we check the box, right? We've mastered the ability to be able to create income, get people to buy our shit or our stuff. Okay. The second step is how we're set up. So immediately once you determine that, hey, I want to be in business, okay, I can start selling water bottles. Right, I don't need to have an LLC to start selling water bottles. Now, of course, there's some benefits of us having an LLC. We get inside and outside protection. But the moment that I start saying, hey, I want to start selling water bottles, I'm now in business, okay, as a sole proprietor. Right? I don't need an LLC or anything to essentially be in business, okay? So depending on how affluent or how aggressive we are in this business with creating income, then we may say, okay, let's introduce an entity. Right. And for most small business owners, it's going to be an LLC. Right. It's going to be a limited liability company. Now, there's some tax pros that may advocate for C Corp. Me personally, I'm not a big fan of C Corps for a number of different reasons. They do make sense at a certain period of time. But generally speaking, the average small business owner is going to be better suited with an LLC. So we bring the LLC into the mix. All right. So now we're looking at how much revenue the business is generating. Okay, so our general rule of thumb is once that business begins to net over $30,000, we should consider for that business to be taxed as an S corporation. Okay. So that's one of the biggest issues that I see with a lot of small business owners is that their business is not set up right. So they've mastered creating income. They're good at it, but they're getting hit over the head and they're paying a ton of self-employment tax because they have the LLC. They check the box there, but they're being taxed incorrectly. And so to put it in context, let's say we got a business that's netting $100,000. You're paying 15.3% on that $100,000 and solely in self-employment tax. That's $15,300. On top of that, you're paying federal income taxes, okay, depending on your tax bracket, 22, 24%. And if you live in a state like Wisconsin, you're also paying state income tax at around 5%. Yeah. So, I mean, things can really get, the bill can get high pretty quickly.
Yeah.
So the first step is to make sure that the business is set up correctly.
So how would it change between an LLC and then an S Corp for tax purposes? Would you now be paying that self-employment tax?
That's a beautiful question. So essentially what happens is, and a lot of people get this wrong. Okay, they think that the S Corp is a different entity. Okay. An S Corp is not an entity at all whatsoever. It is not an entity. An S Corp is a tax election. So think of a tax election as, let's say, right now you're if you're not married, you're single, right? So when you get married, you have to tell the IRS, hey, I'm now married. Okay, tax me as married filing jointly, or tax me as married filing separately. It's the same concept with the S Corp for the business, because when you originally created the LLC, you're taxed as a sole proprietor. We fill out a form. We make sure that the form is filed correctly. And then we're now waving to the IRS and we're saying, hey, tax me as an S corporation. So the entity structure is still an LLC. Okay, but we're now saying, hey, tax me this way.
Huh. What's different with the S Corp?
So with the S Corp, what happens is, so let's take a step back. With an LLC, you file on what is known as a Schedule C. Okay, if you're filing as a sole proprietor, right? Single member LLC, there's no other partners in the business. It's just you. You're gonna file on Schedule C. Okay, and that Schedule C just reflects nothing more, nothing less, but the income and the expenses that came out of the business. All right, and that Schedule C is composed of your 1040. Okay, so in your 1040, that's your personal tax return. It got your date of birth. See, your date of birth doesn't show, but it got your first name, last name, social security number, your address, if you have any dependents, any W-2 wages, dividends, interest, whatever. Okay, and then you got a Schedule 1, you got a Schedule 2, you got a Schedule B, C, D, E, F, whatever. So on the Schedule C, remember, you're going to pay that self-employment tax on your entire net profit. When we switch over to the S Corp, we're no longer filing the business tax return at the same time when we file the personal tax return. Okay. Because remember, I just mentioned that when you're a single member LLC, you're going to file a Schedule C, which gets filed at the same time your personal tax return gets filed. So the biggest difference is, A, you're not filing a business tax return simultaneously when you file your personal tax return. But 2, more importantly, is with the S Corp, okay, you file what is known as an 1120S. That's the tax return for an S Corp. Okay. But you don't pay self-employment tax on your net profit. Okay. No more. So remember the example I gave you. If you net $100,000, 15.3%, that's $15,300 on your entire net profit that you're going to pay in self-employment tax. Okay, when you go over to the S Corp, you don't pay no self-employment tax on the net profit. So I can net $100,000, but I'm paying no self-employment tax at all.
Gotcha. So what are the downsides? Why wouldn't everybody do it?
Now, the downside is, so it's not that easy, okay? So we know converting over to the S Corp, I'm going to save on paying self-employment tax on my entire net profit. But the IRS gives us new rules and requirements and parameters that we must abide by to ensure that we're in compliance. Okay. And one of the biggest things to that is what is known as reasonable compensation. And reasonable compensation is basically what you pay yourself. Because when you go over to the S Corp, you're now also an employee of the business. So you're the first employee of the business. So you have to run a reasonable salary on yourself, and that reasonable salary that you run on yourself is subject to self-employment tax. Okay. So what happens is this now puts us in the driver's seat to control how much we pay in self-employment tax versus automatically paying it on our entire net profit. Yeah. Now we control it by only paying it on what we run a W-2 payroll for. So the nuances is, okay, now I have to run, W-2 payroll. It's basically like growing up. There's more responsibilities. Yeah. You're now in control of all these other variables that come into play. And if you're thinking about an S Corp, this is where you got to have a tax advisor. Because the S Corp is just the tip of the iceberg. I mean, that's easy. Anybody can be taxed as an S Corp, but how do I make sure I'm running reasonable comp? because what you don't want to do is overpay in W-2 payroll, and then that would defeat the whole purpose of you transitioning over. So what's that sweet spot? Okay, and that's what we help our clients do in a tax advisory, tax planning engagement. Okay. So why everybody don't do it, it varies. It depends. It could be perhaps maybe they have an interest of taking the company public. Okay, if they have an interest of taking the company public, then they may want to consider being taxed as a C Corp, right? They may not want to be taxed as an S Corp. If they don't have any interest of taking a company public, then we may need to look at being taxed as an S Corp, depending on if they check the box on the income, does it make sense, and so forth. Okay,
so like an LLC, like you wouldn't have to worry about changing to an S Corp if you're making under $50,000 maybe in income, because then it doesn't matter too much. And going to an S Corp, there's going to be a lot more rules and regulations where you got to start paying yourself and making sure all your ducks are in a row. Like the LLC, you can start pulling money out, just taking a draw out of the account. That's not happening when you got the S Corp. Now you got to start paying yourself and stuff like that.
Yeah, you gotta start paying yourself. You can still take money out of the business. So when you're filing on let's say you're a single member LLC, taxes a sole prop, whatever you take out of the business is considered an owner's draw. Okay, and owner's draw is the same term. It has the same meaning as what we call, if you were an S corporation, as a distribution. It's the same thing. We're just taking money out of the account, and that's literally what we advise our clients to do. So we find a sweet spot on what the reasonable comp is, the salary, and then for everything else, we take distributions for.
Gotcha.
And with distributions and with owner draws, we can't write that off.
Okay. So how would that be on the bookkeeping if it's not a write-off? Then it would just be part of the income as well?
It would show up in the net profit.
Okay. As the distribution, or
it wouldn't show up in net profit as a distribution. It would just be included in the net profit. On the balance sheet, it would show as distributions.
Okay. Interesting. What are some things that people might confuse that they think that they're a write-off, but they're actually not a write-off? Like, I feel like there's a lot of things that like I've thought of that are like, oh, that's easy, that's a write-off, it's for a business. But then like tax people are like, oh, you can't do that.
Sure. Yeah, mortgage payments for, my real estate investors. And most real estate investor seasons, they know this, but, the folks that's starting out, the beginners, they don't know. Mortgage payments are that's a non-tax deductible expense. You can't write off mortgage payments nowhere in the United States of America. However, you can write off the mortgage interest. Okay. So we can write off the mortgage interest, but we can't write off the mortgage payments. And I see that a lot of times with my new real estate investors that bought their first owner-occupied duplex or triplex or rental property or whatever. They got mortgage payments included in their profit and loss statement. We got to take that out. The second thing is they're trying to write off owner draws, what they paid themselves if they are a single member LLC, Texas or sole prop. You can't write that off when you're taxed that way. You can write it off when we go over to the S corp route, but the only way we can do that is on the payroll side. We can't write off owner's draws and we can't write off distributions. Right. Another caveat that we see is on mileage. Okay, so when we leave, I'm always encouraging my clients that you should be tracking your miles as much as possible. Even if you don't take a mileage deduction, track your miles anyway, because you tracking your miles gives us added proof to be able to show the IRS or to show the State Department the percentage, the use that we use that vehicle for, considering you don't have another vehicle, just right? Business, yeah. Let's just say you don't have another vehicle and you just have this one car. If you drove, let's say, for the year, 10,000 miles, right? But we logged in our Mile IQ or in our QuickBooks that we drove 5,100 miles, then we can prove that we're using that vehicle for more than 50% of the time for business purposes, which is the rule as it relates to writing off vehicle deductions. So I always recommend for us to track mileage, even though we don't use the mileage deduction. But what I see happening all the time is clients, they're including mileage in their, they're including the mileage from their, let's say, from your house, okay, to your first customer visit, right? That's commuting miles, right? That is not a that's not a business mile. That's a commuting mile. Okay. Now it goes to a business mile when I go from the first client to the second client, right, or the second client to the third client. Okay. But when I go from the third client back to the house, that goes back to commuting miles. And this is why we encourage for all of our clients to have what we call home office. Because if I have a home office in my house, I'm not leaving from my house anymore to the first client. Okay. What am I leaving from? The home office. I'm leaving from the home office. Yeah. I'm leaving from the office to the first client. So those are some of the few things that we see quite often that folks try to deduct that they can't deduct. Another one is clothes, and there are some cases where you can write off clothes. I try to stay away from trying to write off clothes because if it doesn't have your logo or some type of branding on it, then technically we're not supposed to be writing that off unless it's for a specific use, like right? Uniform, exactly, or hypothetically, let's say you needed to have a photo shoot for your company logo or whatever it was, but it has to be for a very specific use, and you wouldn't necessarily use those clothes outside of that.
Okay. Yeah. Another thing I'm thinking of too is car payments.
Car payments too. Yeah, unless you're leasing the car.
Right. Yeah, that is different.
Yeah, if you're leasing the car, we can write off. We'll take all of the direct expenses, so we can write off the car payments, gas. All of the direct repairs associated with the car. But if you're financing a car, then we got to take, again, it's going back to the interest. We can't take the actual payments itself.
Gotcha. What about I'm thinking of a lot of people say a lawnmower is commuting from house to house, a construction site where you're going from construction site to construction site. Can you write off the gas for the vehicle that you're driving from site to site?
Sure. Yep. So there's two ways to take a vehicle deduction. We can either take the mileage method or we can take actual expenses. So the mileage method is very simple, exactly what it sounds like. We just take miles. Okay. If we do the actual method, then we can take the any direct expenses. So that's repairs, that's gas, that's oil changes, that's tune-ups, any costs associated with maintaining and operating that vehicle up to the percentage that we use that vehicle for business purposes. Okay. Right? So if I only use that vehicle for 50% of the time for business purposes, at the end of the year, if my entire car expenses were $1,000, we're only taking $500. Okay. But how do we come up with that business usage? Right. How do we come up with that? Yeah. We come up with that by tracking the miles to be able to prove that, hey, we using this vehicle for more than 50% of the time for business purposes. A caveat to that, because some taxpayers, they don't track miles, on like a Mile IQ or QuickBooks. But we try to gather a log some way, somehow. And sometimes we'll take the odometer reader from the oil changes when the client go out and get the oil changes. So we try to make sure that we can have some type of log, and that's another thing too. So Code Section 162A tells us exactly what a tax write-off is, and a tax write-off is anything ordinary and necessary in the pursuit of income. This is the direct definition of a tax write-off. Anything ordinary and necessary in the pursuit of income, but whatever we deduct, I'm a big fan of having support documentation because a lot of folks are afraid of getting audited or being summoned for an examination, rightfully so, I understand. But they're really not that big of a deal. We see them all the time. We mainly see them from taxpayers that self-prepare their own tax return. It's getting really high. They just hired 80,000 new IRS agents. So you can only expect for audits to increase. And they're now using AI to score tax returns too. So I would get a tax pro right away. Otherwise, you just putting yourself out there to be at risk. But the point here is that I always want to make sure that we got some type of support and documentation, because if it happens, because people get randomly selected, there could be nothing wrong with your tax return at all. You could just get randomly selected for an audit, and we just want to make sure that we got everything there and we can present them with the facts and circumstances as it stands. Yeah, totally. Receipts, everything, keep all that, and keep all your ducks in a row. How often do you see audits like that happen? We haven't seen them that much. The self-prepared stuff. The self-prepared stuff, we see it a lot. By the grace of God, in our practice, we have not ever had a client audited. Okay. Right? Thankfully so. Not saying it won't happen in the future, but I mean, we try to do everything exactly by the book, and we understand how tax returns are scored. But typically, we see all this happening from those self-prepared tax returns. Yeah. And I'd say this year we probably picked up about 7 so far. Last year we did maybe 40.
Okay.
But
people that come to you after it's happened to try to
hey, we got this letter. We need to respond by this date. What's going on, KL? Type of situation. Okay. And then we partner. Ironically enough, we partner with a lot of CPAs and a lot of other tax firms that don't do that type of work. Because that's a niche based business, if you will. It's so the tax space is so wide. I talked about tax planning, which is more so on the consulting, the strategy side. Yeah. There's firms, they don't do tax returns at all. Okay. All they do is tax planning. Yeah. Then you got firms that do tax prep. Then you got firms that say, hey, we do tax planning, but they really don't even know what tax planning is, but they think they do. And then you got tax resolution, but tax resolution is very compliance, man. Mm-hmm. It's a lot of compliance, and you're dealing directly with the IRS. Okay. I mean, like, you could be sitting across from somebody just like this, and they got their book out, you got your book out, and it's just like the tax code, not to get biblical or religious or anything, but the tax code is like the Bible. I mean, some people understand the Bible or interpret the Bible differently than others. Mm-hmm. When people do things or advise things based on their interpretation of it. And sometimes these revenue officers, that's what they call, sometimes these revenue officers, they may have a different interpretation of their internal revenue manual than how we interpret it. Right. So sometimes we may disagree on what certain things mean. It's just like court. Uh-huh. We may disagree on what certain things mean, and they may deny something. Okay, but just because that person denied it doesn't mean that it's over. Right. Because a taxpayer has rights, taxpayer bill of rights, where we can appeal their decision and often take things all the way up to the United States Tax Court, which we have, and then fight it there. In most cases, if it goes to the U.S. Tax Court, typically it's a good case, and we'll win. Okay. So yeah, it just depends.
And what are things that most people are getting like audited for, like not claiming income, writing off too much? What are like common things like that?
Yeah, not claiming all of your income, violating the hobby loss rule, and you're taking losses, every single year, and the IRS is like, hey, like, are you running a business or are you running a hobby? Yeah. Like what are you doing here? Now, here's what we see a lot happening, and I'm glad we're talking about this. So, like I mentioned earlier, I'm always doing consistent, continued education, right? It's a requirement in our business. All of my team is doing it. And I'm on these national conferences or these national meetings, webinars, if you will, and they happen once a month, okay? Last year, where do you think the Wisconsin Department of Revenue was on the list? Out of 50 states, what number do you think they was?
30.
Okay, so they were 27.
Okay.
Last year. What do you think they at now?
2.
7.
Okay.
That's a big jump, man.
Yeah.
That's a big jump. So and I'm always talking to the Wisconsin Department of Revenue all the time because, stuff happens. Sometimes clients can't make payments. We got to put them on an installment agreement. Or let's say we got a client on an installment agreement, but we got a client that got sick and client forgot to make their payments on time. And since they're sick, they haven't gotten the chance to read the letters that's coming in, or maybe they're scared to read these letters. Believe it or not, a lot of folks are like, they get a letter from IRS or the state. They're like, dude, I don't even want to open it. And they just sit it on the shelf for so long. And I'm just like, no, we got to open those letters. And then we open up the letter. They say, hey, we're going to levy your account in 30 days if you don't respond. And then by the time we get the letter, it's day 29. Yeah. And so now we got to go back and forth. Anyway, what the State Department is looking at right now is taxpayers who have a W-2 job, okay? But then they got a Schedule C. Remember I told you the Schedule C just reflects the income and the expenses for the business. Yeah. And that Schedule C got a lot of losses, and they're leveraging those losses to offset their W-2 income, right, which tremendously increased their tax refund. Dude, they're over that crap like white on rice. And some of it is legitimate, because, I mean, it takes a lot to start a business. And you might be negative in the first year, 2 years, but if it's egregious, you just open up yourself for an audit.
Okay. Yeah, because I see a lot of people doing that. I feel like people buying like a rental property or something, and then they start the LLC. They have a normal job, but now they buy the rental property, and that's Schedule C income because they're going to start renting it out. And then they start like writing off like the purchase price could be like a huge one first year. Like that's a huge offset. And they're going to audit stuff like that, you think?
Well, so with rental properties, don't go on a Schedule C.
Okay.
So Schedule C is for active businesses.
Gotcha.
So if it was a fix and flipping business,
Yeah.
it would go on a Schedule C because that's active, right?
Okay.
But rental properties is passive. Active income and passive income will get taxed completely separately. Passive income is not subject to self-employment tax at all. So the rental property is going to go on the Schedule E. Okay, so that's going to go on the Schedule E. Now, what happens is, so if, let's say you work a W-2 J job, let's say you don't work a W-2 J job. If your income goes above $150,000, then the IRS caps. They say, hey, you can't take none of these deductions on your rental property to offset any of your active W-2 or your business income. And if it's under $150,000, and it's a little more technical than this, but if it's under $150,000, every American, every U.S. taxpayer gets a $25,000 special allowance that they can leverage. Okay. So that special allowance is basically, let's say I got a rental property. The rental property, let's say it made $1,000 for simplicity, but it went negative $26,000. Okay, so my negative now is 25. Right, depreciation, auto, travel, all the stuff that goes in there. Now I'm at 25. Okay, so I can take 25,000, right, and I can leverage that 25,000 as an expense against my W-2 active income. So if my income at my W-2 day job is $100,000, instead of me being taxed on $100,000, I'm only going to be taxed on 75. Yeah. Okay. Now, once you hit 100,000, it begins to phase out. Once we go above 150, they say, no, Hunter, you can't take. You're not subject to the $25,000 special allowance anymore. You can only leverage those passive losses to offset other passive income. So if I had another rental property and that rental property netted $25,000, then the negative loss from the other property of $25,000 will wash those both out. I pay no tax, right, on the other one. But I mean, let's say you got really good at creating income in your business, or let's say you're a W-2 employee that, I mean, your income is above 150. You could be a C-suite executive. It doesn't matter. You could just be good at sales. I mean, you could be in IT. Who cares what it is? You're making above 150. Well, now that's when we start entertaining the ideas of you being taxed as a real estate professional. We call it reps tax status, where if you're taxed as a real estate professional, you're not subject to the $25,000 special allowance anymore. You can take whatever you want.
Oh, really?
Yeah, you can take whatever you want. Now you gotta meet some tests, and you gotta classify as for reps. But more importantly, it gives us the opportunity to be able to, really do some magic, man, on the tax return. I'm always pushing for my clients to buy real estate just for that reason, and that's why I buy real estate every single year. Yeah. Because the moment I stop buying real estate, I'm gonna get hit. So I have to buy real estate.
Gotcha. So yeah, it keeps like rolling over. Oh, here comes a beat towards you.
Yeah.
Get that out.
Spot it, yeah.
Get out of here, dude. But so every year you want to keep buying real estate, so you like keep compounding that, and then when you stop buying it is when like you kind of take a hit per se.
Me personally.
Okay.
Not everybody. But I'm gonna take a hit because what I do is I play the long game. Okay, I'm not buying any property that I think I'm going to sell. Okay, now I might liquidate one, I might liquidate two if I need to free up cash to do a bigger deal. But for the most part, every single property I'm buying, I'm playing a long-term game. And then there's some people who they like the stock market. They like real estate. They like both. Me personally, I'm a real estate guy. However, me being an accountant, I do understand the importance of being able to diversify and have a Roth IRA or have the ability to be able to self-direct your retirement account. We can talk about that if you want. A lot of people don't know they can do that. But I'm a real estate guy. So my real estate portfolio is my supplemental retirement income for me as well. And if I buy one property every single year, if I just do that one thing, I just buy one every single year. And I look up in 10 years and 15 years, and I got 15 rental properties that's, my tenants done paid down the mortgage, right? I got all this equity. I can now do HELOCs against these properties, and I can now leverage that debt to go out there and buy more rental properties, or I can sell maybe half of my portfolio and pay off my remaining mortgages, and now I own these properties free and clear, and I'm cash flowing every single year.
Yeah.
Right? If I'm cash flowing $3,000 across 10 rental properties, let's say I'm cash flowing $3,000 a month across 10 rental properties, that's what? $30,000 a month.
Yeah.
Right? That's $360,000 a year.
And they're paid off, yeah.
And
So
they're paid
mortgage,
off,
yeah.
on real estate. And on top of that, I also had the Roth IRA doing this thing. Maybe my income was too high, so I had to do a backdoor Roth. Okay, yeah. And a lot of folks don't realize, that they can do a backdoor Roth. I was talking to a client while I was overseas, I was in Portugal for 2 weeks, and they were like, yeah, my previous accountant told me I can't contribute to a Roth IRA because I make too much money. I said, that's BS. There's always a way.
Yeah.
We can do a backdoor Roth. We can get you in there. And I love backdoor Roths, and I love Roths in general because I'd rather pay the tax now, rip the Band-Aid off. Let's just pay the tax right now. So once we get 59.5, we can just don't have to worry about it. I can't tell you how many clients, I got that's retired, and they're like, yo, why do I still have a tax bill?
I know. Yeah, that sucks. Imagine paying all the tax up front. I was talking to a financial advisor. He owns an advisory firm, and he was talking about, like, wealthy people will create a Roth for, like, their heirs of their wealth. So then before they die, they put all their money in a Roth. They pay all the tax up front. So then in their will, they give the Roth to all their descendants. Then they don't have to pay any of the tax and have all the money that they can use then.
Yeah, that's an option too.
Which is so interesting. I wouldn't like think of that. Like, you'd think like of just handing the money to people, but then all of a sudden you have to pay all the tax on it.
Yeah.
But if they take the hit and then you just give it to you as a gift after they're gone, it's like, what?
Done.
There's no tax.
Yeah, there's no tax. Here's the daddy head start. Well, here's the grandpa head start. We should want to do that.
Right.
Like, why? Like, what's? And I see people on social media. Oh, I'm a self-made millionaire, and I figured it all out by myself and on my own, and I made it to the top. And I'm just like, dude, like, great for you, but like, fuck that, man. if I can make it easier for my son or my daughter to be very wealthy, I will do whatever it takes to do that. Right. Now some people may say, oh, you're going to spoil them. They may be a little bit weird. They may not value certain things more. Well, dude, that all comes down to what you teach them and the principles and how you upbringing. That's it. Right. And I think it's a lazy excuse to not want to become the best version of yourself, which is, in my personal opinion, we're all obligated to do that. Because I don't know anybody that ever died and came back to life to tell me, anything different. So me personally, I think that we all are obligated to become the best version of ourselves. And if we continuously do that, then we now can provide value to other people. Yeah. And a lot of folks, I talked about the first step in business, and I'm very passionate about this. I talked about the first step in business is not the tax write-off, but it's creating income. And I got a lot of clients. They're like, hey, Eugene, I've been stuck at $500,000. Every year I'm stuck. I'm at $500,000. I'm stuck. Or I'm at $100,000. I'm stuck. Well, I don't know what to do. I'm stuck. And when you stuck, that's a breathing point for a decline. Because only thing that's constant is change. And we understand that in business we have expenses, and typically expenses tend to go up. Right. Every single year. Then we got this magic word, that's inflation, that inflates things as well every single year. So if you stuck at $100,000 and your take home or you stuck at $500,000, your take home is slowly diminishing. Yep. And then I asked clients, I said, well, when was the last time that you read a book? When was the last time you went to a conference? When was the last time you went to a meeting or a webinar or a networking event? When the last time you bought an online course? And they be like, man, it's been a long time. It's been 5 years. It's been, 10 years, or I never have. Never done that. And that's the reason why you stuck. Because what's in your bank account is nothing more, nothing less, but a reflection of what you have up here, right? And I got a saying that goes, the more you learn, the more you earn, right?
Yeah.
The more you know, the more you grow. And the more you grow, tying it back to real estate, the more the cash flow. You know what I mean?
Yeah.
So if you feeling stuck, then you need to get out here. You need to learn. You need to stretch, man. And because people pay for value. You know, your clients pay for value. That's it. That's what they're paying for. You know, and you got to be committed to continuous growth and self-education. And that's my favorite tax write-off. Taking it back to taxes.
Yeah.
That's my favorite tax write-off. Self-education. Can you believe it? Can you believe that you can't write off like going to a 4-year university and getting your degree?
Right.
You can't write that off, man. Huh. You can write off the student loan interest.
Okay.
But you can't write off you going to get the degree.
Right.
If the semester is what's the average cost of
like $30,000.
$30,000 a year, a semester, right? Or not a semester, but a year. Right, 4 years, that's 30, 60, 90, that's $120,000 in the average in the U.S. You got $120,000 worth of education that you can't deduct, and the only thing you're writing off is the interest. But if I go self-educate, right, and I go get certifications, and I go get licenses, and I pick up courses, and I buy books, all that shit is 100% tax deductible, man. Self-education.
Yeah.
Right? Self-education is the education that make you wealthy. Right?
Totally.
That's my favorite. I love when I see education on a profit and loss statement, man.
Interesting. I never even thought of that, to write off a book or something like that.
Yeah, man, self-education. You know, I love it. The things that make you more money, you can actually write it off.
Yeah.
Crazy, man.
That is crazy. Yeah,
but you can't write off a 4-year university, but they'll let you go into debt for it. They'll let you go into debt for it, but they won't let you write it off.
Yeah. Which
Come on, man.
I mean, that's...
The system is rigged.
Yeah.
It's rigged.
It's insane, yeah.
It's rigged, man.
And then YouTube is free education.
And it's free education.
Yeah.
Let's talk about free education.
All right, let's get it.
All right. Now, you may have a different opinion, okay, or you may agree with me. I have a saying that goes, people who don't pay attention.
Okay.
Think about that. People who don't pay attention. I can't tell you how many times, you know, I've gave somebody free information, a free strategy, a free plan, you know, coming out when I first started.
Yeah.
You know, free advice, free plan, free consulting, do this, do that, do this, done.
Yeah.
Take no action.
Totally.
The person that pays $5,000, the person that pays $10,000, now they're committed. They got some skin in the game. They want a return on their investment, right? Because sometimes we need a bigger return on investment than time, because some people don't value time, you know, but they do value their money. And what I realized is that people who don't pay attention. That's why I don't believe in giving away things for free anymore.
Yeah.
Because I'm going to do you a disservice, because I know that the average taxpayer, the average person, the average client, they're not going to take any action if I just give it to you.
Right.
But if I make you committed to getting a benefit, to getting a specific result, I know you're now more likely to take some form of an action. So I believe that wholeheartedly, man, that people who don't pay attention.
Yeah, I actually agree. I feel like a lot of people like are the ones that are just scrolling on Instagram and like seeing all the motivational videos and stuff, and they're just posting it up, but like it's doing nothing for them.
Yeah.
Like they're just scrolling and looking at it's like free video. This is all motivation, but then it doesn't show in their work ethic or what they're doing in real life. These videos that they're watching aren't helping at all. It's just in their head of it seems like it's helping, but it's really not helping.
It's motivation.
Yeah.
Right. And motivation is motivation is an emotional state. You know, I can wake up one day and be motivated.
Yeah, feel good.
Right. I woke up this morning motivated. Right. I might go to bed demotivated.
Yeah.
You know,
2 hours go by.
2 hours go by, I'm not motivated no more. You know, it's an emotional state, and motivation comes and goes, but what stays is that commitment that you made to yourself. Right? It's that self-discipline. It's that burning desire to become the best version of yourself so that you can serve better. You know, and if you want to build wealth, then figure out how to serve people better. You know, and that's why I got it in the tax space, because I'm always constantly serving. I'm always constantly delivering, you know, and I'm always constantly prioritizing my own personal, professional self-development. And the more I do that, the more I look at my bank account, and it just grows and it just grows and it just grows. and then I create that philosophy or that culture in my community, right? In my community, it could be you, it could be friends, it could be family, but more importantly, in my business too, right? And if everybody is all thinking the same, because here's what I believe too, and I'm huge on philosophy. I don't know if you caught that yet. I'm big. Your philosophy shapes your future. Your philosophy shapes your income. And what I realize is that people will only be able to accomplish what is what they believe is below their belief system. So if you believe here, okay, and your goals is down here, right? Oh, you could hit that all day, right? Oh, that's small. Right? That's small.
Yeah.
But if you got big goals and your goals are up here, but you're not believing at the same level, you're not operating at the same frequency as your goals, you'll never hit them because you don't believe.
Yeah.
You got to be all in, and you got to believe. And all in is one of our words in our practice, is you got to be all in. We don't want you half-assing anything. You got to be all in. Either you all in or you all out. Because if you half-assing or you halfway doing anything, you're all out.
Right.
Right, you're not doing this to the best version of yourself, and that's what we want, and that's what we've seen to have, a big shift in our practice.
Yeah, and I think that can be like incorporated with anything in life. Like I was just thinking, like even athletically, if you don't believe here, you're never gonna get there. If your goal is like here, or if your goal is above it, you don't believe you can do it, you're never gonna get there. Like even with golf, we were just talking about golf a little bit ago. Like I didn't think I could get par like on every hole, like. I wasn't confident in it. I was terrible. Like I was confident in getting double bogey every hole, and then like you hit a good round, and all of a sudden you're like, oh wow, like I can do this, and then all of a sudden par is like fine one day, like it's like the normal.
Yeah,
that was my goal, and now it's just like it feels right to be hitting it, and it doesn't feel like I'm playing crazy good. It just feels normal, like I'm confident. And then you have one day where you're playing terrible, and you're like, well, how do I get back there? Mm-hmm. It's like you got to always have the confidence up here. Because golf is totally a mental game too.
Oh, for sure.
You just have to be confident in your game. Otherwise, you're never going to get to where you want to be.
You said something that struck me. You said normal.
Yeah.
And the word normal is so powerful because we have the ability to create a new normal.
Right. Totally.
We have the ability to go out here and create a new normal. And I think that new normal shows growth, right? That new normal shows growth, and I'm always constantly chasing that new normal, man.
Yeah. What's something that you're chasing in right now?
It's for me. I'm in a space right now where I am actively growing our practice, and we're bringing on new people, and I realize, and this is me being vulnerable. And I realized that I got so heavy in the business development and the self-growth and, helping and serving our clients that I forgot to serve me. Mm-hmm. And what do I mean by that? Okay, so I'm serving me by going to conferences and continuing my education and prioritizing self-development. But there was a portion of my self-development that I was leaving on the table. And that was my overall well-being and my health, and working out and, eating healthy. Because sometimes, when we create a new normal, that new normal sometimes comes with other things that we didn't realize that came with. Yeah. So as I'm out doing business development, talking to people, and, sometimes we're going to, Capitol Grill. Sometimes we're going to Gibson. Sometimes we're going to STK. Things kind of get a little bit on the unhealthy side if you're not paying attention. And so I think for me, the new normal that I'm chasing right now is hitting the gym more frequently, eating healthy, healthier rather. And that's kind of where I'm at. I just did a vacation. I've been gone for the last 3 weeks. I was in Portugal for 2 weeks. I came back for 1 day. Then I went to Dallas and I went to Salt Lake, and I'm back.
Wow!
Right, all over the place. And I'm so happy to be back because, okay, now I can create a new normal for me, but on this aspect.
Yeah.
Right. And I'm a member at the Milwaukee Athletic Club. and I go there, but when I'm not working out. How do I create a new normal for myself where I can prioritize, my health, my body, and what I'm consuming as well? Because, you are what you eat.
Yeah.
Right? And that means you are what you consume. So that's the audiobooks you're listening to. That's the podcast that you're listening to. That's the conversations that you entertain. That's the company that you keep. And that's also the things that you eat. Yeah. Right? And that's what I'm prioritizing right now.
So is it mostly goals that you set, or is it just be more conscious of everything, of working out, of eating healthier? Or is it like a set regimen, like I'm going to start eating this, I'm going to work out this many days a week, I'm going to do this many reps?
I'm like that. I'm very systematic in a way where I want to know the system. And I realize that me being wired that way may not always be good for certain things I haven't caught just yet. Because I'm not perfect, right? And I think with me in this new normal in this space on the health side, because everything else I got a system written down on paper, like process doc. Yeah, look, this is how it goes. But I think in this space, I just need to just show up, man.
Yeah.
Just start showing up first. Once you start showing up and keeping that commitment to yourself that you will show up for yourself in that way, then curate the system. Okay. So I think for right now, my goal is to just show up.
Yeah.
Keep it very simple and just show up.
Yeah, I think that people set goals almost too high out of the get-go. Like, you see that on, like, the New Year's, all the commercials are, go get the gym membership for cheap or whatever. And everybody's saying, like, oh, I'm going to go to the gym every single day for an hour. And they just don't end up doing it because it's not something that's feasible. Like, I see a lot of people that are like, yeah, I'm going to go to the gym every single day. And they just jump in to the deep end right away. And then they do it for a week, 2 weeks. But then at the end of it, it's nothing because you just can't keep sustaining that, especially if you don't have a goal set in place where you're like, I want to get to this weight by this time, and I'm not giving up. I'm doing it. Like, I'm a big believer in, like, I do a bunch of working out here just, like, at home because it's, like, quick, easy. Like, I'll go for a run. I'll do a 30-minute thing on, like, the TV or something like that, just, like, a little thing to get me moving because I know if I was saying to myself that I'm going to go to the gym every single day, there'd be, like, 3 days where I'm like, I just don't have time to drive 15 minutes there, 15 minutes back, and then finish it out because there's just not the time first thing, not the motivation to go there, where you could just wake up, do it at home quick, bang, done, and it's just more feasible in my opinion. I know there's a lot of people that think maybe like going to the gym is like more motivating, like I feel good about myself, I'm going to the gym, but I think there's a lot of people that overcommit and set their goal almost too high, that they never even achieve it because it's just too high. Yeah, and they're just jumping in the deep end right away without having any lead up to it.
You know what? You said something that's powerful, and I tell folks this all the time too, and I apply it to myself. Is you want to start creating those. One of the keys to my success, and I study people. I have business coaches. Is creating those small daily wins.
Yeah.
Those small daily wins are so important. They're so crucial because it gives you the it gives you the ability to.
There we go. Nice.
Yeah, thank you. Those small daily wins are so important because it gives you the ability to create that momentum, and build that confidence, right? And if you don't have the confidence to do something, then like the likelihood you won't do it for a long period of time. But if you can slowly just don't go for the home run, just go hit first base.
Yeah.
Let me just focus on hitting first base today. I just want to hit first base today. That's it. And then tomorrow I want to hit first base again. And then tomorrow I want to hit first base again. Okay, now let me go for second base. Right? And what people don't realize is that success is here. We brought up social media for a second. Okay, people scrolling. Social media, I think, has created there's pros and there's cons to social media. And what I'm seeing on social media, or as a result of social media, is a lot of people are constantly and consistently comparing themselves to someone else who may or may not actually be living the life that they're portraying to be living. on social media, and I think that sometimes that can steal your joy. But social media also is in most people's space, or it's their highlight reels, man. It's not the, oh, I did this and I lost 50,000. I said I lost 50,000 on a fix and flip. It's all about the wins. It's not about the losses. And I think sometimes that can really impair somebody's vision as it pertains to them getting to where they want to go. And tying this back to, I just want to hit first base. I just want to hit second base. Dude, success is a compounding effect.
Right.
It's not a get rich, build wealth, be successful overnight type of thing. And a lot of us, unfortunately, we have microwavable mindsets and we want instant gratification and we want instant results, but it just don't work like that. And I don't coach that way. I don't preach that. I preach compound. Let's just show up today.
Yeah.
And if we show up every single day with the same intensity, right, and we make good decisions every day, if we make more good decisions than we make bad decisions over a 10-year period, dude, we'll be fine.
Right. Yeah. And I think that's important for a lot of people to just have like something that you do every day that's helping you grow.
Yeah.
Like I started, I want to say like 5 years ago, I do like 4 minutes of planks just every night. Just something that I can do just every night. And I know if I can do that, then I'll sleep well at night. Like just something easy that you can do like every single day that just like kind of grounds you. And it's like, I did something that was hard, but I got through it and it helped me grow a little bit maybe.
Yep.
And I know I talked to this other guy too, Craig Shufflebond, I have it on the podcast, and he talked about like how in the newspaper after 7 years of starting his company and grinding every single day is like, now all of a sudden everyone's saying like, I'm the overnight success. All of a sudden I'm the overnight success and got to where I was in a week. But it really took him like 7 years of compounding and every single day going. And now everybody's looking at him like, oh, you just did this and it was easy. Like, it's not like that. You don't see everything that all these people are doing that are to where they got today.
Yeah.
Which is so important. And just to keep that compounding going, even if other people aren't seeing it and giving you the gratification that you're doing a good job.
Yeah.
It's just knowing yourself that you're
absolutely
going.
And it's having a good team around you, a good support system. I think we all should have some type of personal board of directors is what I like to call it. And, your board of directors can be your parents, it can be your significant other, it can be, a business coach, a relationship coach, a life coach, but everybody should have their own personal board of directors. And that personal board of directors is the people that you lean on when you need advice and you need some type of guidance or coaching on something. And it's crazy that we bring this up. While I was on my way here, I texted one of my two of them, personal board of directors. I sent one a text. I sent one an email. Hey, can we jump on a call between now and Wednesday? I got something I'd like to talk about. I got something that, I haven't seen yet. And I think that's important to be able to have those people that we can tap into when we need it. And part of creating that personal board of directors is not immediately kicking a relationship off asking for something.
Right.
But trying to figure out how you can give as well. And I think that helps create for a fruitful relationship.
Yeah, I totally agree. And I feel like, a lot of people, like you said, are just the people that want to receive. They just want to keep getting from people. Or as a relationship should be like give, take. You help lift them up, they help lift you up.
Yeah.
I think that's important that people have to like foster and facilitate good relationships like that.
Here's I'll give you this. We talking about giving and taking, right? You ever met somebody where all they talk about is something bad happened to them?
Yeah, right. Yeah.
Oh man, somebody broke into my car. Oh man, I lost this. Oh man, I had this appointment, but my appointment got canceled. It's always something bad happening, and sometimes I get inquisitive with stuff, and I ask myself, I wonder if they're a giver or a taker. Because if all you do is just take, and never give, at some point the universe is going to start take. And I got a buddy of mine where at one point it just seemed like it was always the next thing after the next thing after the next thing after the next thing, and I'm like, damn, man, what's going on? Let's talk. Let's have a conversation. Tell me more about what how do you live? What you're doing. And he was constantly take, never give.
Yeah.
Right. And it's okay to give. And I was just having a conversation around this this weekend in Salt Lake, and I was talking to another tax pro, and she was talking about how sometimes, clients get in tough situations, and we'll do a tax return for free.
Mm-hmm.
And we will too. Obviously we're for-profit business. We're not a non-profit business, and we're in the business of making a profit. But at the same time, sometimes you got to give as well. It's not always about you.
Right.
It's not always about you. It's about being able to serve sometimes as well. And I think that if you can serve, if you can show up, and if you can find that balance between, taking and giving, you'll be all right in the long term.
Right. Yeah.
I'm trying to not. I'm practicing discipline.
Yeah.
We're not swatting off
the bees.
These bees.
Yeah. It's fun doing a podcast outside, though. I like.
Yeah, it's good.
It's heating up too out here.
Yeah, it is.
So nice out.
It is.
I love it.
Yeah, it was 90 something in Utah. It was
it
right,
really?
though. Yeah, I was in Dallas too. Dallas is so humid, man.
Oh,
I
yeah.
love Dallas though.
Yeah, Dallas is super fun. We actually sold one of our boats. So with the Wake Surf Lessons business, every 2 years we get a new boat and then sell our old one.
Okay.
So we sold the boat to a guy in Dallas-Fort Worth. And so he came up, drove up, picked the boat up, drove it back down there. And part of our deal was that I had to throw in a lesson with it. So now I got to fly down there, and he paid for my flight and everything, which is cool. But then I got to spend like a weekend with him in that area.
Okay.
We went out and surfed, taught him how to use the boat, everything.
Oh, nice.
It was super cool.
Nice.
And I've never been there before, and I liked it. It was a lot of fun.
Dallas is nice.
And those express lanes are crazy. How nice are those?
Dude,
Why doesn't every city have that? Right?
Who knows? I think Dallas has a great young professional market.
Mm-hmm.
There was a point in time where I was in Dallas twice a month.
Okay.
I got a lot of clients in Dallas, and one of my goals is to at some point move down there.
Okay.
There's no state income tax.
Yeah.
I mean, you can get a nice house. I got a buddy of mine down there who, him and his wife just bought a house, bless you, earlier this year. They got a nice 5-bedroom, 4-bathroom house, dude. They picked it up for $600,000.
Isn't that crazy?
Like super high ceilings versus, here, dude, that'd be 1 point something.
Yeah.
Here.
California, even more.
Oh, don't even get me started on California or New York, man.
Yeah.
It's crazy over there.
So crazy.
Yeah, man.
Well, let's get back into the tax a little bit. I want to talk about some of the write-offs with like electric vehicles and stuff starting up. Seeing that we both have Teslas, we can get into that a little bit with tax credits and stuff like that if you want to talk a little bit about that.
Yeah, so with the EV credit is $7,500. Okay. Now, there's some income, constraints with that. Not to go into the technicalities and too deep into the weeds, but the EV credit is $7,500 as long as we can check some boxes, right? And the final assembly is done in the U.S.
Okay.
We're good. We can check the box. We can get the $7,500 EV credit. Now, that EV credit is a non-refundable credit. Okay, so you have refundable credits and you have non-refundable credits, meaning that EV credit is only kicking in if you owe. Okay. So if you have a $7,500 balance on your federal tax return, then that EV credit will kick in $7,500. It'll wipe it out. You'll owe nothing.
So does it go straight against the tax that you owe, or does it go against your income?
It go against the tax that you owe. It's a credit directly towards the taxes.
Oh, wow.
Yep.
And is that just in the year that you purchased the vehicle?
That typically you should take it in the year that you purchased the vehicle, or the year that you placed the vehicle in service, let's say.
And does it have to be for more than 50% of the business use?
No.
Okay.
So you could get the EV credit and it doesn't have to be business.
Really? So it could just be for personal use?
Yeah, you can get the EV credit just for personal use.
Wow, very interesting.
Yeah.
And could you write off, say, the vehicle, you could write off under business expense if you paid for it in full because you couldn't write off the payments type of thing. But could you write off like the down payment or payment if it's used for business?
You're not writing off down payments per se.
Okay.
Again, what we could take is the bonus. We could take bonus depreciation on the car, but we're not writing off down payments or anything like that.
Okay.
No, but we would take bonus depreciation, and then if you're financing, in this case, you would have had to finance to get the vehicle. We would take the interest.
Gotcha. But if you did pay cash on it, you could write that off if it's over like a certain weight, correct?
Correct. So if it's 6,000 pounds or more, right, then in 2022, it was 100% bonus depreciation. You can write off 100% of the car, right, in year one that you purchased the car, right, and then it's been phasing out by 20% every single year, right? The Trump Tax Cuts and Jobs Act is phased out 20% every year. It should be completely phased out by 2027.
Okay.
This will be the last year. So 2024 is 60%. Last year was 80%. This year is 60%. 2025, it'll be 40%. 2026, it'll be 20%. 2027.
So it's not getting as appealing anymore.
Exactly. Unless somebody revise and say, hey, let's do this.
Okay. Interesting. Were a lot of people using it in 2022? I'd assume so.
Oh, of course.
Yeah.
I mean, that's all I saw in 21 and 22 on social media. Hey, buy a G-Wagon and
Yeah, exactly.
write the car off, and they didn't tell you that you got to have some money to write the car off.
So did that go straight against your tax bill as well, or was that against your income then?
So that drives down your income.
Gotcha.
Right. So that doesn't go straight to the tax bill. That goes directly towards income. So if I got, let's say it was 2022 and I bought a vehicle for $50,000, right, and I had a net profit of $100,000, I could bonus depreciate that vehicle right off the whole $50,000. Now my net profit is not, $100,000 anymore. It's $50,000.
Right. Yeah.
The beautiful thing I like about depreciation, and this is why I tell my clients about real estate every single year, is because lenders will add the depreciation back to your income.
Okay. Explain that better.
Yes.
It's a dumber way for me.
That's why real estate is the best tax benefits. It has the best tax benefits out there.
Okay.
Sun is starting to pick up and blind me a little bit.
Yeah, right.
So basically what happens is lenders can add the depreciation back to your income. So for example, let's say I netted $100,000 and I got $100,000 worth of depreciation kicking in somewhere. I'm paying no tax on that $100,000 worth of income because I got a $100,000 loss. Okay, but depreciation is what they call a phantom loss. Okay, it's a gift from the IRS. All right, it's a gift from the IRS, and they give it to you because you're placing assets in service for the business. But more importantly, as a business owner, you're helping create what? Income, and with more income, you can create jobs, right? And the government wants a stable economy, and they understand that. I mean, the United States of America, whoever doesn't understand it, is built on capitalism. If you don't understand that, you need a newsflash, right? So basically, the lender can add the depreciation back to your income, and that's why I got a lot of clients that don't pay nothing in tax. They pay nothing. I mean, these are 7-figure earners, and they're not paying anything in taxes because we leverage depreciation and we leverage certain things in the tax code to be able to do that. Now we can write off, meals and travel, but those are all direct expenses that we can't add back.
Right.
And if you're looking to buy a house, that lender's going to say, unfortunately, Eugene, but you're not bankable, right? I see you grossed $500,000, but you got $500,000, you got $450,000 in expenses.
Right.
I can pre-approve you based on, the $50,000, right? If you're a small business owner, they're going to look at the previous 2 years, but I can pre-approve you on that $50,000, but I can't pre-approve you on the $450,000 or the $500,000. But if you have depreciation, right, expense, they know to add that back. And so if I made $500,000 and I got $500,000 in depreciation, I paid no tax, but B, I'm still financeable because the lender is going to add that $500,000 worth of depreciation expense back to my income.
Right. So how is the real estate depreciatable?
So real estate depreciates and it also appreciates. Some people can kind of get that confused, right? So residential real estate depreciates over 27 and a half years. Okay. Commercial real estate depreciates over 39 years, right? Two separate components. Okay. So residential 27 and a half, commercial 39. Here's where I see we talked about audits, self-prepared tax returns, right? Somebody would depreciate a short-term rental, Airbnb, VRBO, over 27 and a half years.
Okay.
That's an issue. But wait, why? If it's a duplex or if it's a single-family home, that's residential, Eugene, right? That's not commercial, right? So why is that? Well, it's about how you use the property. Okay, it's about how you use the property. So in Airbnb, the average guest stay is typically 7 days or less, right, in Airbnb. So that's not long-term anymore, right? And that falls under the scope of commercial now. So that gets depreciated over 39 years, not 27 and a half years. And so we see a lot of that stuff on the tax return, man, where the depreciation is all wrong. And that's one of the easiest ways to get audited. If you have an Airbnb and you're depreciating it over 27 and a half rather than 39 years, man, that can cause a lot of red flags on tax return.
Huh. So is it the full amount that just like is split up into each year? So say it's like
correct.
$500,000 house, and then you just appreciate that split up in each year?
27 and a half years.
So it's not like a big lump sum in the beginning and then slowly fizzles out, or vice versa?
We can do that. Okay. Now, that's known as accelerated depreciation. Right? And we can do that via a cost segregation study. And what a cost segregation study is, a engineering company is coming out and they're looking to see everything in this house that has a useful life of 15 years or less.
Yeah.
Okay, so what is that? They're looking at the roof. They're looking at the appliances. Furnace. The flooring, the cabinets, right? The PVC piping. And they're going to accelerate the depreciation on that, okay? And creating a big deduction for us to take in year one. Now, in order for us to do something like that, we got to qualify for real estate professional tax status, which is what we strive to help our clients hit. Because remember, I told you that you only can take $25,000 worth of deductions against your active income if you're under $150,000.
Okay.
But once you go above the 150, you phase out.
No, it's less.
That can be it's gone completely. It can only wipe out other passive income. But if we qualify for real estate professional tax status, now we can leverage all of that against our active income. So we got some clients where we'll do some very advanced strategies, and we'll qualify them for real estate professional tax status. And there's a couple ways to qualify. You know, I'll tell you what those tests are. So you have to materially participate. If it's long term, you have to materially participate in that rental activity for 750 hours or more. Okay. In a 12-month period, in that calendar year that you're looking to take the deduction. Okay. You have to materially participate in that rental activity more than anyone else. So if you got a property manager, not happening.
Yeah.
Okay, these properties have to be self-managed.
Okay.
Okay, you have to self-manage them. Okay, so you have to materially participate in that rental activity more than anyone else, okay, and more than 50% of your time.
Okay.
So remember I told you whatever deductions that we take, we got to create a log, right? So there's a website known as repstracker.com, and you can use Reps Tracker to log every time you go pick up rent, okay, and you're talking to the tenants about issues. Every time you go over there to cut the grass, every time you go over there to fix the dishwasher, every time you go over there to change the light bulbs, every time you go over there to meet with a general contractor or whatever it is, we got to start logging these hours.
Yeah.
Right? So that's the long-term way to hit. And we could do some sophisticated stuff. If we got more than one rental property, we can group them all together or whatever. That's a little bit more technical than we got time to talk about. But we can do a dashboard, grouping, election, whatever. Or we can say, hey, you may say, hey, Eugene, look, I don't got time I can't hit 750, man. You know, I mean, that's just not possible for me.
Yeah, I'm sure a lot of people, it's not possible for, yeah.
Yeah, they're like, yo, I can't do this. Okay, well, let's entertain the idea of having a short-term rental. Because if we can entertain the idea of having a short-term rental, we don't need to hit the 750 no more. We only need to meet the 100-hour material participation test.
Okay.
That's it. 100 hours. That's it. And I have to materially participate in that activity more than anyone else.
What does material participate in the activity mean?
Yeah, material participate is kind of what I just mentioned, right? So it's cutting the grass.
Okay.
Right? It's checking the tenants in, right? It's changing out the linen, washing the clothes, per se. Or you could hire, a cleaning lady, but now you got to make sure that you're spending more time at that property more than that cleaning lady. Because remember, you got to spend more than anyone else, right? It could be changing out the light bulbs. I mean, it could be anything associated with you physically at the property. right? You physically at the property, material participation. We're not counting travel time to the property. They got very strict stuff with that. Okay. We're not tracking, travel time to the property. This is you physically at the property, logging hours. So decorating, right? If it's an Airbnb, we got to furnish the place. We're decorating. All these things on material participation.
Is that hard for people to do? I feel like getting that many hours has got to be hard for a lot of those people that maybe have multiple of them as well. Or does it just have to be one property that they're participating in?
So it could be multiple. Okay. It doesn't have to be one. Okay. Right. It could be multiple, but if it's multiple, we would have to do a grouping election. Okay. And then we would group those property together. We would do a -4 grouping election. We'll group those property together. And then ultimately we're leveraging 4 properties as one activity.
Okay.
Follow what I'm saying?
Yeah. So
but they all have to be short term though. They would all have to be short term rentals. And then we would group all those together. And we can also classify that way.
Okay, so by short term, would they be like 7 days or less?
They have to be 7 days or less.
Okay.
Yep.
And for more than that, like if you're on like a month to month like leasing thing, would that be completely different?
That's long term. Now that's long term now. Okay. So we not under the short term or no loophole no more. Gotcha. Now we back at long term.
Do you mostly do short term or long term?
I'm a long term guy.
Okay.
Personally, I have one short term. I'm a long term guy. But many of my clients may not have time, and I'll say, hey, let's do a short term rental, and we don't got to keep it as a short term rental. We just need to do it for the year that we're trying to classify as for reps. Right? We could do it the first year, and if it doesn't go well, if we don't want to do Airbnb no more, cool. Take the furniture out, done, whatever, and then we go back to long term.
And so you have that license, that reps.
So it's not a license; it's a tax status.
Okay.
So, but you have reps for that year. And that's the year that we take in the deduction. That's all we care about, is that we meet it for that year. Because you have to meet it every year. Right? So as long as we meet it for that year, we can take the deduction.
Take a big one for that 1 year and then not do it anymore?
Exactly.
Gotcha.
Exactly. If we want to continuously do it, we got to hit it for every year.
Okay. So is that usually like a big year for that person? Like they have a bunch of income that they have to offset?
Exactly. We don't do it just to do it. Obviously, there has to be makes sense to do it.
Yeah. Gotcha. Okay, sweet.
What time we got?
How long we've been talking for?
Yeah, I think I'm more time. Yeah.
Let's wrap it up quick. Yeah. I'll ask you 5 more questions quick, just short, quick ones.
Oh, I'm way over.
Way over?
Yeah. 23 minutes over for another meeting.
Shoot. All right, 5 questions.
Let's go.
30 seconds or less answering. Favorite place to eat?
Harold's Chicken, Chicago.
All right. Favorite sport to watch?
Basketball.
Favorite professional athlete?
Kobe.
What'd you want to be when you were growing up?
Police officer.
All right. And advice for a young entrepreneur, if somebody just getting into business?
Find a mentor.
Awesome.
Find a mentor. Don't be afraid to believe in yourself. Try things, but don't try things that could be. Don't try things that could give you a financial setback without you doing your due diligence up front. So spend time doing your due diligence. Okay, hire a mentor, or hire a coach, and get around like-minded success seekers, and find out who you really are, what your values are, what you want to do, and that may sound a bit lonely or weird, but sometimes you got to spend time with yourself and really figure out what it is that you want.
Yeah.
Because what you want will help you determine who you are, and then also if you're looking for a soulmate or a spouse, it'll help you save a lot of time of weaving some people out, because now you have a GPS for yourself and exactly what you want. And then the last thing that I would say is to just go for it. Just go for it. Be all in, and don't. It's not all about money. It's about being happy, because there's money can't buy happiness, but it can buy options. You know what I mean?
Yeah.
And I prefer options over obligations. So this was good.
Totally. Dude, so fun.
Thank you, man. You got it.
Thanks so much. That was awesome. Yeah, we went for a long time.
Yeah.